I'm glad you started with that because it's a really tricky time in the real estate market to try and be forecasting, but everyone wants to know where things are headed, right? And so I think what I've been thinking about is, what are the things we should be paying attention to, and what are the things, frankly, your buyers and sellers are paying attention to and are worried about, and how can we pull together information to help those buyers and sellers make confident decisions in this crazy market. So that's kind of where I'm coming from. But I want to thank you again for the chance to be here. I'm going to share my screen. I'll also send these slides out afterwards, and then that way you can feel free to use them if any of them are helpful. I'm going to focus on sort of what's going on in the greater Washington area housing market. And Emily, as I mentioned, if anything doesn't look right with the screen, just give me a shout. Okay. Because I think I'm seeing something a little bit different than what other.
And everyone, this is also interactive, so don't be shy. If she's going over something, please raise your hand. You can shout out. Really? Here for questions.
100%. And even if you think of something afterwards, that's great. And even afterwards, I'll have my email address at the end. But first, let's take a look at kind of where we've been. So I want to show a few charts that look like this. So the dark blue line here is monthly closed sales in the DMV last year in 2025. And the orange line is where we are here in 2026 through March. We'll have April data here in a couple of weeks. But what we've been seeing is in our area, 2025 was a pretty slow year for sales. And you can see the gray area on this slide. That's the range of where sales would be over the last decade. So as you can see, the last couple of years, transactions have been really low, coming off a really busy pandemic era sort of housing market. And there'd been a lot of optimism that 2026 would be a rebound and we'd see a lot more activity. The idea was that mortgage rates were going to fall and that more buyers were going to be in the market, more sellers were going to be listing. And so far, it's been a slow start, just to be frank, in terms of sales. Uncertainty, affordability remain headwinds in the market. Mortgage rates fell briefly below 6% in February, but with rising geopolitical uncertainty, we've seen mortgage rates heading back up. So the picture for the spring market is changing a little bit. There are some promising signs. So this is pending sales each month. And as you can see, the number of new contracts on homes in March was higher than it was a year ago. So we're basically up from where we were, more inventory coming onto the market. Again, that dip in mortgage rates, a lot of pent-up demand in the market, even with all the uncertainty. And so there are signs that buyers are ready to jump in. And I think there's some pushing and pulling on the market here that we can talk about to see whether those buyers are going to materialize this spring, whether we're looking into the summer, whether there's still whether the hesitation that we're seeing on the part of some buyers and sellers is going to ease, or whether that's something we need to be kind of planning for throughout 2026. I'm showing data on the whole DC Metro, but as you all know, it varies depending on where we are. So this shows year-to-date sales by local market in 2026 compared to where we were in 2025. So you can see sales are up in Fairfax and Montgomery County, but sales are quite low in the district proper. We're seeing slightly slower sales in Loudoun County this year than we did last year, but Loudoun did pretty well last year. I think in Loudoun, the slower sales is a factor of too little inventory and not a decline in buyer demand. But in the district, as you can see, we've seen a pretty sharp pullback in sales. But pending sales is more positive. Like when you look across the jurisdictions, with the exception of Prince George's County, we're seeing more new contracts in 2026 than we did in 2025 at this same time period, which suggests that that pending sales are up for the region, which means that buyers are out in greater numbers this year than they were last year. One of the tailwinds to the market, one of the positives for bringing more buyers into the market, is that home price growth has started to ease. And you can see this chart shows the change in the median sold price in the DC area year over year. So look back in 2021, 2022, double-digit price growth. We saw a dip in 2023, primarily because prices, escalated so quickly the year prior. And you can see that dashed line. We're seeing kind of a slower growth in home prices. And that is a good sign. Even, some people might think, well, if I'm a homeowner, why am I glad home price growth is slowing? Well, if you're ever going to be a seller of your home, we really need to get back to a market where home prices are growing at the same pace as incomes. For so long, home prices have been exceeding the pace of income growth. And so we're starting to see a more normal pace of home price growth. But the thing that's really struck out to me is this sort of K-shaped housing market. I'm not sure if you've heard of that term before, but what we're seeing in our market here in the DC area, as well as frankly in most of the country, is the upper end of the market is performing much better than sort of the entry level and mid-tier market. And so what you can see here is how have home prices changed this year compared to last year for different price points. So if you are selling a home, let's say under $500,000, under $600,000 in the DC metro area, prices this year, sold prices, are lower than they were last year, right? So buyers at that price point are more price sensitive. At the upper end of the market, in the mid-tier and upper end, $800,000 to over $1 million, we're actually still seeing prices in that segment of the market on the rise. We've seen higher income buyers are more active in the market. We've seen them less sensitive to some of the uncertainty that there is in the market. And I think it's an open question about whether the luxury end of the market or the higher end of the market is still going to continue to be the driver of the market in the DC area. I expect it will be, at least in the short term, though one of the wild cards is whether stock market volatility impacts the luxury buyer. Luxury buyers are more likely to be all cash buyers than buyers in lower price points, and that all cash opportunity is harder when the stock market is volatile. And so, but for now, my takeaway for this is if you're working with a seller and you're trying to talk about pricing, looking at what's happening to the median price may not be as helpful as sort of looking at it for the particular price segment that your seller is in, because it does vary across.
We have a question from Katie.
Yes.
Yeah, thanks. So on that slide, the price segment 1 to 2.5 million, do you have any insight to, like, is that consistent across that? Because in reality, there is a huge difference for buyers from the 1 to 1.5, versus like the 2 to 2.5. So
for sure,
like in Get Smart charts and in Bright reports, it's always, to me, really frustrating that is such a huge range. Because that's a break point for buyers.
I hear you. And in particular in our market, like if you go to, like, let's say the Philly market, like 1 million is the same as 2 million is the same as 3 million in Philly. That's an expensive house. But in our market, as you guys know, it's funny, just as an aside, my two researchers that I work with, one lives in Indiana and one lives in Florida. And they came into town and I decided to show them like $1 million houses. And let's just say they weren't too impressed by what you can get for $1 million in Fairfax County and Montgomery County, Maryland. To your question though, I think 2 points. I think the way that I've looked at this is those homes at the kind of $1 million 1 to 1.5, they're probably going to be closer to, a half percentage point rise of, under 1% increase. Whereas, so when you get up to the 2.5, $3 million homes, those homes are fewer and further between. And so the pressure on prices is higher. So to your second point, though, I hear you about this large price band being really unhelpful. And we're currently working on a new tool to access data at like finer price points. But for the question of how prices are performing in the kind of lower end versus the higher end of that 1 to 2.5 million, I think it's not even throughout, and the lower end is going to look more like the sort of 0.5% year-over-year price growth, and the higher end is going to be a little bit higher just because of the limited inventory.
Oh, that's interesting. I actually would have thought it was the opposite, because we're just getting into like that's entry level for like a detached home.
Right.
And there is a lot of competition there. Whereas houses at the 2 million, 2.5 mark, I don't know that they have that same level of competition. So
Yeah,
on the ground, I'm actually
that's
seeing
interesting.
prices get bid up. Like there was just this last weekend, there was $1 million house with multiple
Yes.
offers, and it ended up going for 1.2.
Is that right? That's fascinating to me. Okay, I'm going to dig into that a little bit more because I think that's a really important point. And you've sort of like my general point, which I think you've reinforced, is that, you know, when you're talking to clients, the market is very different depending on where you are. And you mentioned single family detached homes. Like, I feel like that market has been on fire, even as demand for condos has been really weak. So on pricing, just sort of like reinforce this, you know, we're still seeing multiple offers in some markets. We're still seeing offers above asking price in some markets. So the average is sometimes a little bit misleading. So this is the average sold to original list price ratio in the DC Metro. And you can see in 2021, 2022, on average, homes were selling for above asking price, 3-4% on average. We know in some properties, it was selling for like 10-20% above list, but on average. And you can see that the sold to original list price ratio has declined, and it's under 1 for the DC Metro as a whole. But if you look in different markets, and I know this is kind of a crazy chart and it's not a lot of difference there, but you can see Fairfax County is the dark orange line, Loudoun County is the lighter orange line. Homes in Northern Virginia suburbs, particularly in single family detached neighborhoods at that $1 million price point, most likely, are still commanding offers above asking price. And I think it's definitely been market to market when we talk about this. And I think that's one of my things I've been thinking about a lot is your clients are often hearing about the national housing market, or maybe even the DC area housing market. And having the local data is always important, but I think it's going to be even more important now because conditions are varying so much from market to market. Interestingly, I mentioned townhomes, and we did a survey. We do a survey every month, and of agents that were either the buyer representative or the selling representative on a property that closed during the month. And we don't collect data in Bright on multiple offers or on the number of offers, but in the survey, we asked the listing agent, how many offers did your seller get on the property? And we're still seeing in the DC area, more than half of sales are still getting multiple offers, 53% of. And so that, to me, and this is survey data, so this is only based on the people who responded, but we did get 1,000 people to respond, and a couple of hundred of those were in the DC metro area. And so we're seeing still a very competitive market, which sort of belies maybe what some of your clients might be hearing about the national housing market. We're getting a lot of noise from the national level that the housing market is cooling and that homes are sitting on the market for a long time. And maybe that's true at the national level, but here in our marketplace, it's still pretty competitive, and buyers are still sort of, sellers still have the advantage in most markets, unless you're trying to sell a condo. The condo market is feeling a lot different. Homes are taking longer to sell, but it's like there's a big asterisk to that, right? So this is median days on market on the left, and it's very seasonal, which is why it's so bumpy. And DC metro wide, median days on market was 20 for the first quarter of 2026. That's up more than a week from where we were last year. So we're still not back to where we were pre-pandemic in terms of length of time homes are taking to sell. But the bigger thing to me is look at how much difference there is. If you are selling in Loudoun County, the median days on market is still a week, meaning half of all homes are selling in less than a week. And even that probably doesn't talk to how quick the market is in Loudoun County, for example. Fairfax County, the Northern Virginia jurisdictions of Arlington, Alexandria is still a very quick pace historically. The median for the region is being driven really by the district, where the median days on market is now 55. So it's taking almost 2 months for the typical home to sell in DC. Prince George's County, you can see as well. So while the median days on market is lengthening, and that's probably a high level number that folks are hearing, if you are in some highly in demand markets, homes are still moving really quickly, right? Relative to historic standards. One of the reasons we're still seeing sellers have an advantage in many markets and buyers having to move quickly is, even though inventory has been rising over the last couple of years after dropping to very, very low levels, we're still not back to where we were in 2019. In fact, across the metro area, even as the number of active listings has been on the rise, and that's what that chart shows, the month-end active inventory, we're still only at about 88% of where we were in 2019 or in 2020, right before the pandemic hit. And you can see the share of 2020 listings across the region varies, and Loudoun County is definitely the tightest inventory across the market, across the DC area. Arlington and Alexandria are a little bit of a strange number there. You can see it looks like there's more inventory now than there was prior to the pandemic. That is entirely driven by the condo market. If you were to look at the inventory of single family, it is still quite tight in Arlington, Alexandria. And then you can see DC and Prince George's are above where we were. Montgomery County is sort of in between. But in general, the Northern Virginia suburbs have been more competitive than either DC for sure, and even more so than Montgomery County over the last 6 months or so. I mentioned about the condo inventory. So this shows DC metro wide. So you can see the blue line is the number of detached homes available on the market. Back in March of 2019, it starts. And you can see we haven't recovered in terms of available inventory in that segment of the market. So for buyers in that segment, it's still really competitive. If you are a prospective seller of a detached home in a Northern Virginia market, you can expect there to be ready buyers for that property if it's in good shape and priced well, because despite what people might be hearing about a cooler market or a uncertain market, or there was a lot of hyperbole about the DC market tanking because of DOGE and because of federal government, cuts, and it definitely is not showing up in the housing market, particularly in that segment of the market. The primary constraint in our market, honestly, for years, has been a lack of inventory. The message has been, if there was more inventory, we would have more sales. And you can see the dark blue line again is the number of new listings coming onto the market each month in 2025. The gray is the range over the last 10 years. And 2025 was really slow. Now, I'm going to direct your attention to two little bumps in 2025, one in March and one in September. People ask me, did the federal government cuts, did DOGE have an impact on the housing market? And in general, we did see an uptick in new listings in March when the DOGE announcements were made. And we saw an uptick in new listings in September when that fork in the road ended and people were transitioning out of the federal government. We didn't see a similar bump in those 2 months in, let's say, Philadelphia, for example. So I do think there was a little bit of a timing shift of when new listings came onto the market, but overall, listing activity was still really low in 2025. We did not start 2026 out so great. February, we had the lowest number of new listings coming onto the market in history. I have data back to 2003, so I couldn't find another month when we had lower new listings. Part of that is, I think, part of that is people waiting for the spring, which totally makes sense. People waiting for maybe the mortgage rates to come down. They're anticipating a really busy spring. They want to be there in the mix. I will also say, I don't think you can overstate the importance of weather in the DC area. I've been in the DC area for 30 years now, but I grew up in Vermont, and I'm still perplexed by how little snow can shut things down. And I do think so weather and it's been very cold, I think had a psychological impact on people's decision, because we saw a very nice uptick in new listings in March, still below where we were last March, but remember last March was a little bit strange. So the question for me is, as we see more listing activity heading into the spring, are we going to see the buyers then come into the market? And everything feels a little bit delayed, but with more listings on the market, will we see more people coming in? And even though we saw an uptick in March, new listing activity is still slow, and we still, I think, need more new listings to come on if we want to see a robust, active spring market. I think inventory is still a constraint. So this is the number of new listings coming on the market this year compared to last year. I'll point out Loudoun County again, very tight market for buyers, not getting any better, at least here in the first quarter of 2026. Now, people are like, well, why aren't there more new listings? And you all know this better than I, is, for some sellers, they have a very low mortgage rate and they're not interested in giving it up. At the same time, some people who may be living in homes that are too big or they want to downsize, they're looking around and they're like, well, where would I move? And so it's sort of the limited inventory is sort of self-reinforcing. And I think it's going to take some time to work through that. The good news on that, not the good news, but the silver lining on that is, if anyone's ever concerned, oh, well, our home price is going to crash, or we're going to see a big drop in home prices, it is impossible to have a big drop in home prices with inventory still so tight. It's just the law of supply and demand doesn't work that way. And so I think it's going to be a very hesitant housing market. It's going to take some while to get back into a balanced housing market. But in some ways, that's good. We don't want a big surge of inventory all at once, because that's when we do see prices softer. I'm going to talk about the things to look at as we move into 2026. I'm just going to pause just for a moment to see if there's any thoughts or questions on what we've seen so far. But as we go into 2026, I think it's a tug of war. I'm not sure who's going to win yet. I think there are very much positive signs for the market. There's a lot of pent-up demand in the housing market. There's a lot of people who have been wanting to get into the housing market. They've been waiting. There was so much optimism as mortgage rates fell below 6% briefly in February, that lower rates, slower price growth, improving affordability was going to be able to bring more buyers into the market. More inventory was going to also be an enticement to those buyers. But at the same time, we are faced with a lot of economic and geopolitical uncertainty that is driving mortgage rates higher, that is creating concerns for people around their own economic situations. And affordability is still a major challenge, particularly for entry-level first-time buyers in our market. Let's talk about mortgage rates first. This is the chart. It shows the average rate on a 30-year fixed going back to 2010. You can see hit record lows in 2021, and then a very fast rise in mortgage rates. This is what created the lock-in effect. People who bought at very low rates are now feeling locked in, waiting for rates to come down so that gap is smaller. You can see at the end of 2025, headed into 2026, we saw rates start to fall. As I mentioned, hitting below 6% according to Freddie Mac the third week of February. And then the United States entered into a conflict in the Middle East, and that uncertainty caused a 5-week run-up in mortgage rates, hitting back up to close to 6.5%. Last couple of weeks, we've seen rates fall back just a little bit, but I do expect that until there's some resolution with what's going on in the Middle East, until oil prices come down, until there's more certainty about inflation, I don't think we're going to see mortgage rates fall below 6% again this spring. And I think that's sort of the new normal. Will rates fall below 6% eventually this year? Yeah, possibly. But we had anticipated in our forecast rates falling below 6% sort of by mid-year. And while we saw that briefly, I think this volatility in rates around 6.5% is probably where we're going to be. And one of the reasons why rates could move higher is that, rates tend to track where the 10-year Treasury is at, and this is daily data. I can't remember the last time I updated it. I think it was like last week when I updated it. But and then oil prices have been on the rise. When oil prices are higher, inflation is higher, mortgage rates tend to rise. And inflation, like I mentioned, inflation was down at 2.4% in February, and then in March we saw inflation shoot up to 3.3%, driven by higher oil prices. When inflation is higher, mortgage rates tend to be higher. All of those things are one reason why the forecast for a very busy spring market has been pulled back a little bit, because the affordability picture is changing for some buyers. The other thing to watch is how people are feeling about their job security and about wages and about their own financial situations. And job growth has been softening. So the economy has been softening. You can see this chart shows monthly job change. The orange line would be like the average before the pandemic. And we've been sort of back and forth with jobs at a national level. The unemployment rate is still pretty low, but it's been ticking up a little bit higher. And so the labor market is still pretty resilient. And we're not in any fears of a recession, but there are people who are worried about their jobs. And when they're worried about their jobs, they're less likely to make big decisions. This is the DC area though, and the DC economy has been weaker than the overall national economy. So this shows monthly job change going back to 2021. And we've had several months of job loss in the DC metro area. We've seen the unemployment rate, which is still relatively low, but we've seen the unemployment rate rising. And we've seen slower job growth in the private sector, but we've also seen, of course, the effect of federal government employment. So this shows the number of jobs in the federal government. That sort of cliff you see right there is partially a recording phenomenon. The job cuts that were made as part of DOGE that went into effect at the end of September show up as a sharp decline in federal government employment. We actually have the lowest level of federal government employment in the DC metro area that we've ever had since 2009. And because the federal government is such a big chunk of our economy, when federal government slows, so too does our overall economy, all the private sector jobs that are tied to the economy. You know, there's, I think sometimes this gets overstated though. It's like, oh, the, big drop in federal government jobs. We know a lot of folks in the housing market are federal government workers. Won't that cause them to pull back? And, we've seen a little bit of that, pardon me, but overall, I think what it's led to is just a sort of a softening in the housing market, a slower housing market pace, but there's still a lot of pent up demand that is untouched by changes within federal government employment for sure. Affordability, though, is touching everybody who is kind of in the entry-level market. Back in March of 2020, the median price in the DC metro was $479, and mortgage rates were at 3.5%. So you can see, using some standard underwriting assumptions, a buyer would need an income of about $108,000 to purchase the median priced home back in 2020. But look what's happened. We've seen not only have home prices risen, we've seen mortgage rates higher. And now that a buyer would need an income of over $180,000 in order to qualify to buy the median priced home. And, not everybody's buying at the median. People are buying at the lower ends, but it is a sign of how much affordability is affecting folks, particularly those first-time buyers. You can imagine even like a young married couple, both maybe, let's say, working in the federal government, GS7s, GS9s, or at, a combined income of $100,000. That is just barely enough to get into a condo or a very small townhome, and it's certainly not enough to get into the median priced home or into a single family home in much of the region. And people often ask me, when is affordability going to improve? And it's going to be a slow haul. Affordability is still going to be a challenge. We need rates to come down. We need price growth to slow. And that doesn't happen overnight. In fact, we don't want that to happen overnight, because anytime anything happens really fast in the housing market, that's never good. So 2026 is still going to be a transition year where affordability is still going to be on people's minds, and where sellers who still have the upper hand in many markets are still going to be looking at a buyer pool that may have less ability to pay The other thing they'll also be less interested in is buying a home that's a fixer-upper or that's going to need a lot of work. Like those are the things we're hearing in some of our surveys. And just to end on sort of the economic uncertainty piece, we did a survey in December, and we asked people about how they're feeling. And a lot of folks are feeling uncertain and worried about their economic situations. And this is sort of showing up in some of our other consumer sentiment data. The University of Michigan puts out consumer sentiment data every month, and last month their measure hit the lowest level on record. The conflict, of course, in the Middle East, the rising inflation, higher gas prices, these are all weighing on people's minds. And when people feel uncertain, they're less likely to do big things like buy and sell a home. So what does this all mean? Like, I feel like there's a lot of news out there that suggests like a delay in the spring housing market. And I think that's probably what we're looking at as buyers are hesitating, waiting for some stability in interest rates, maybe waiting for more stability, certainty in their jobs. I do think mortgage rates will stay above 6%. I do think we're going to have more inventory, and it will be a better market this spring for buyers who are ready to buy. And by better, meaning in general, again, not every local market, but in general, more inventory, more leverage for buyers, but still needing to be sort of ready to make an offer when they're ready to buy. The wild cards, I've sort of touched on the conflict with Iran and how the uncertainty is creating upward pressure on mortgage rates, is creating volatility in the stock market, and none of that is great for the housing market. And so the sooner the conflict in the Middle East is resolved, the more likely we will return to a stable housing market, and in fact could see a real sharp bump in housing market activity if rates do start to stabilize. What happens with federal government employment is going to be important in our market. The new Fed chair is slowly making his way through confirmation hearings, and there are still some political hangups there. In my opinion, it's not who the Fed chair is, but the fact that the Fed chair transition is being politicized is not good for the market. Generally, the housing market doesn't like uncertainty, and with uncertainty about who the Fed chair, when the new Fed chair will be confirmed, that will keep mortgage rates higher for longer until that the confirmation process goes through. So what do we expect for sellers? I do think sort of resetting price expectations, working with their agent to price their home, in the current market, given current local market conditions, prepare for maybe a little bit more flexibility. We're seeing more and more buyers asking for home inspections, asking for closing cost assistance, cost with repairs, help with repairs. Buyers are increasingly saying, look, I'm not interested in a house that I'm going to have to put a lot of money into after I buy it. So making sure the home is move-in ready. And then for buyers, I think there will be more inventory. There will be more leverage for buyers in terms of negotiations. It'll be maybe appealing to try and time mortgage rates, but man, that's going to be really hard. And a better bet is to make sure you're connected with a mortgage lender who can help you navigate the mortgage market and be ready to get the best rate when it's time to make an offer. And then for you all, there's a lot of anxiety out there, as you've seen from some of our data. So helping to have the information, to be the trusted advisor, to help mitigate risk and uncertainty in the home buying and selling process. I think we should plan on an extended spring housing market. I think, we haven't seen a true spring housing market in a while, and sort of moving decision-making into the summer is probably going to be true in this year as well. And having the data so that you can be the trusted local expert to your clients, to your colleagues, to your community is going to be more important than ever. And to the extent that the data that we share is helpful, I hope you're using it. I'm going to sign off here and see what other questions and conversation we have in just a sec, but I do want to make sure that you're aware of the resources you can get from us. We do monthly housing reports around the 10th of the month at the county level, at the product level, meaning single family versus condo. But we also put out weekly data every Tuesday morning at 8 a.m. that takes a look back at the last 7 days at the DC Metro level as well as the individual county level. So you can see, get a quick snapshot of what the market is doing over the last 7 days. And we have webinars and all sorts of other commentary that we release at brightmls.com/research, publicly facing. So clients, you can send your clients to this site as well. And then you can always reach me via our research email address. And I mentioned the 2 great people I work with. We're always happy to hear from you, particularly around things like, well, do you guys track this piece of market data? Because this piece of market data would be really helpful to me when I'm talking to my clients, or come to us and say, you know, I've been hearing that, you know, this trend is happening. Do you have data on that? For example, we had somebody come to us last year and say, look, I'm hearing that there are more contracts falling through. Do you guys track that data? And we hadn't been, but we started to, and now we release that data on a monthly basis. Spoiler alert, contract fall throughs are rising slightly, but they're not as big a deal as maybe people think they are, at least in terms of tracking that data over time. We also started tracking the number of listings that were withdrawn from the market. We saw an uptick in the number of sellers who were pulling their home off the market. We did a survey. We found out that pricing was the primary reason sellers were pulling their home off the market. They weren't getting the price they wanted. And so now we're watching those listings very carefully to see if they're going to start coming back on the market, if they're going to come back on at a different price, to help us gauge, you know, what sellers and buyers should expect. So anyway, those are just some examples of the things that we look into and start reporting based on questions from agents and brokers. And so we are more than happy to do that. So I'm going to end there. And Emily, I'm going to turn it back over to you and the group, and happy to hear anything anyone's experiencing that maybe doesn't match the data I presented, which I totally get because I'm looking at data. You guys are actually dealing real world, real time, or if there's any questions.
I think Caitlin had a question in the chat earlier. I believe it was talking about why higher end homes versus lower end homes, the demand. So she said, I'm curious if you believe part of the impact is the high balance loan category having aggressive rate impact compared to jumbo and conforming being more optimal.
I think there could be an impact of the, you know, various attractiveness of rates for different mortgage products. In general, though, what we're seeing is that buyers at the higher end of the market not only have access to different mortgage products, but they also have access to different sources of funding, and they have more confidence in their own personal financial situations. So I think all those things combined is primarily the reason that that segment of the market has been more robust than the lower end. And like I said, I'm kind of curious about, I think that's, I'm glad you brought up that jumbo. I should track that better. But also sort of tracking the other factors that have supported the luxury market. Are those things going to still be favorable to luxury buyers? Because they're feeling it in terms of like their stock market portfolio, And I'm always like amazed at the luxury end in the DC area is we have a lot of very high priced homes that sell. Like we do a luxury report every quarter, and I'm going to release that data next week. But it has been a very busy part of the market every month. So anyway. Paul has raised his hand.
A couple things. In terms of like the weekly market, do you guys have any plans of separating it in terms of like structure types? Just because like, I feel like that's really important, because like if you're just seeing the weekly report, you might not be able to discern kind of condo versus single family because it's just one stat. And I think one thing that would be really helpful too is showings, because I feel like we can't pull data from showings as well as Bright, but like seeing like where the showings are occurring.
Love it. So those are great suggestions. So to your first question, I get that. Totally get it. The trick is the weekly data, the numbers are relatively small anyway. And if we start breaking it out into housing types, my fear, and maybe this is just my fear, is it's going to show some wild changes week to week. And people might misinterpret that and say, oh, well, it's up 33% this week for condos in the DC Metro. Well, yeah, but there were only 5 sales. You know what I mean? So I'm a little worried about splitting it out too finely. And I think that sort of analysis is probably best done when you're doing sort of your competitive market analysis for a particular property. Like, right? I feel like that's where you do that. On the showing stuff, we every week, the weekly report has showings data. So that's kind of interesting to see it. But I think we want to do more, to your point, to share out analysis of trends in showing activity, because that's really, in my mind, the most interesting part of the data that we have, because it's this like pre-sale, like we're not a portal, so we don't have traffic like people viewing homes. That's great, but frankly, the people who are viewing homes, are they really in the market, or are they just like hanging out on Zillow looking at homes, right? We're actually working on a analysis right now that's looking at basically answering the question, after how many showings does a seller typically drop their asking price, right? And then looking at showings data is, does showing activity increase in the week following a price drop? Like we're starting to do that type of analysis. But to your question, I think we can and should do a better job at showing showings data by the different product types. We do it in the monthly reports. So if you look at our monthly report for DC area, you can see showings by product type. But I think it's something we want to get into. So I really appreciate that. I get that for sure. Yeah. So the showings. Yeah. Right. So I just read Erica's draft blog on this. So I'm like all in on this showings and price drop stuff. It's it's really interesting to me because it definitely depends on where you are. And I think that gets to this like local market. Like sometimes a price drop doesn't make a difference in terms of the number of showings, because it's not about price. It's about something else. It's about neighborhood. It's about whatever. And I think that's one of the things we're trying to like parse through so that we can make the data as helpful as possible.
Any other questions while we have Lisa?
And Emily, I'll send this slide deck right after the call. And like I said, feel free to, if any of the charts or whatever are helpful, feel free to use them. However.
Yeah. The one thing I always I'm always curious about is like new construction, because like I feel like new construction, a lot of them, like the data isn't as accurate just because it's not ready yet. So I guess, how do you guys approach that?
Paul, you're asking the good questions here. So I feel very stressed out about the fact that we don't have very good coverage of new construction. And I also know that new construction that is entered into the MLS can also be a little bit weird, right? One listing represents 20 homes, or 20 listings represents one available home, and it's not consistent. So to be perfectly fair, frank with you, I don't do a good job at separating out new construction from existing homes. In the stats, we just report out the existing home data. That doesn't include new home data. So yes, we're missing a key part of the market. And that doesn't matter as much, let's say like in Arlington, for example, or, well, even on the condos, it could. Well, the condos often come through. Sorry, I'm talking this through as we go. But what we're looking for is to find an external source for new construction listings that comes via the home builders, so that we can supplement that part of our reporting to be more comprehensive. Because right now, you're right, it is a little sketchy in terms of what we're able to report on the new construction side.